Hi guys, I'm just going to give the other attendees a few seconds just to enter the room, and then we'll get this thing underway. Okay, fantastic. So good evening, traders, and a very warm welcome to this presentation on the Relative Strength Index. Let me just check I'm sharing my screen. Yes, I am. On the Relative Strength Index. And now this is a beginner's guide. And look, as you can see, it's more commonly known as the RSI. It would be great to know how many of us here actually use the RSI or have used the RSI in their trading. You know, go ahead and let me know in the chat box. That'd be great. So I know what kind of audience I'm working with. Those new to FP Market, the FP Markets webinars, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. As always, I want to thank everyone for taking the time out of their busy schedules to be here. I hope you're able to take something away from this presentation. Okay, before we get things rolling, please do me a quick favor and just let me know if the audio is all good and we can all see the welcome slide. For those interested, a recording of the webinar will be available. I will throw a lot at you this evening, so it is advisable to watch the recording if you feel you've missed anything. And these can be found either through the FP Markets website or on our YouTube channel. Our support team will also email attendees with instructions on how to view the recording. Thank you guys for letting me know. Yazid, you've used the RSI before, which means you don't use it anymore, right? Okay, so that hopefully by the end of this presentation, you might decide to reuse it or employ it in your trading. Okay, really quickly, guys, the disclaimer. So trade responsibly. Derivative products are highly leveraged. They carry a high level of risk and are not suitable for all investors. Features of our products, including fees and charges, are outlined in the relative legal documents available on our website. Okay, for anyone that doesn't know me, again, my name's Aaron Hill. I'm the technical analyst for FP Markets. I've been involved in the financial markets for more than 12 years. I'm also a I'm also a CMT, so a chartered market technician. And I also have the CFTe qualification, and I'm currently enrolled on the CFA program, Chartered Financial Analyst. In terms of my trading, I specialize in price action. This has been my main vehicle of analysis, alongside Fibonacci studies, the relative strength index, which we're going to look at right now, and chart psychology. As I mentioned briefly at the beginning, the presentation's focus is on the relative strength index, so the RSI indicator. Look, given the RSI boasts a number of key functions, as I've already said, I have a truckload of content to really get through, as I ultimately want newer traders to present here to walk away shall we say, a more informed trader regarding the RSI. Because I see a lot of confusion, especially amongst newer traders. So please do watch the recording if need be. That way you can pause it and you can take notes at your leisure. With that, first on the scale, I'll be briefly describing the relative strength index, what is an RSI, and highlighting its formula or calculation. I have purposely kept the formula as basic as possible. Next in the queue, as we can see, we'll be looking at the various RSI methods, traders use in their trading, which includes approaches such as overbought and oversold conditions or signals, divergences. This is an interesting one and a common application for many technical traders. RSI failure swings, which as far as I've seen are not commonly discussed, though are certainly worthy of attention. We'll then maybe summarize the presentation and emphasize the RSI indicator as a confirmation tool. And then finally on to a Q&A. We'll open the floor to any questions related to the content. Newer traders are especially encouraged to get involved at this point and ask questions. Remember, there are no silly questions, as we all had to begin somewhere. Right, so without further ado, let's jump into the first slide. And you'll have to excuse my drawing. This was done by me. I'm clearly not known for my artistic abilities. Right, the Relative Strength Index, or for short, the RSI, was designed by a gentleman who goes by the name of J. Wells Wilder. Wilder actually features the RSI in his 1978 book, and I believe that's called the New Concepts of Technical Trading Systems. Now, I have actually read this book many years ago, and for anyone that's interested, here Wilder begins, I believe, talking about the RSI. I think it's on about page 50 or 60. If you're interested, I believe this is available on PDF on the internet now. So do go ahead and check that out. It's definitely an interesting read, especially if you want to get to the roots of the RSI. Now, despite being developed 4 decades ago, the RSI has clearly, shall we say, stood the test of time, and remains one of the most popular technical indicators today. Now, at its core, the RSI momentum oscillator, which, according to Wilder, measures the velocity of directional price movement shown by way of a value that oscillates between 0 and 100. So basically, it measures the speed of the change in price. The basic framework of the indicator, as you can see, consists of an x-axis, as you can see there, which represents time scale. And to the right, we also have the y-axis, which represents the magnitude or distance the indicator has moved. We also have notable levels marked at 70, 30, and 50. More on the uses of these levels a little bit later. Now, a reading above 70, as shown on the slide, is considered overbought, and moves below 30 are viewed as oversold. Again, more on this later. Now, as I briefly said, think about momentum as the speed of price change. For example, if we have a handful of traders buying into a market and price advances, more traders see this movement and trade. Consider momentum-based strategies in particular. And before you know it, we have a strong wave of bullish activity. The question most traders and investors generally ask is, how long will the market remain in this state? Are buyers going to run out of fuel, overheat, so to speak? Prices cannot rise continuously. Also, as momentum turns lower and the market sells off, it often tends to over-deliver to the downside. Another way to think about all of this, of course, is markets are often overreacting to good and bad news. And look, this is where the RSI can be a very, very handy tool to have in your arsenal to help decipher this movement. Generally, the RSI is thought of as a leading indicator. Now, a leading indicator essentially provides a signal before a new trend or move or reversal occurs. However, I've also seen traders refer to the RSI as a coincident indicator, which means it works almost in real time, providing the current situation on that particular chart. Personally, this is just my opinion, guys. I feel the RSI is more leading than anything else. But as I said, this is just really my opinion. So with all of what we just covered, for me, a basic definition of the RSI is an indicator in place to measure momentum in a particular security, be it stocks, cryptocurrencies, commodities, or even foreign exchange. Wilder, basically the developer, the designer of the indicator, basically reasoned that, if gains were significantly greater than losses over a period, then the stock or asset was overbought. And if losses significantly exceeded gains, then it was oversold. Obviously, do not confuse this with relative strength, which is a different animal entirely. So for anyone interested, the most common means of establishing relative strength is through something called the ratio method. In other words, it's a ratio between two instruments to see which one is outperforming the other. The key point in this presentation, though, is to understand that the relative strength index measures the momentum in one market on one time frame. So if you have the RSI applied to your daily time frame, that's the time frame it will measure. If you have it applied to the H1 time frame, that's the time frame, that's the period that it will measure. Therefore, traders who prefer the lower time frames, so think scalpers and day traders, can use this indicator, and also, swing traders as well as position traders can also use the indicator on the higher time frames. Now, it's important to note that the default period for the indicator is set to 14, but traders, and I'm pretty sure some of us here do adjust this to suit their trading style. Now, a lower period, so lower than 14, say 10 or 8, will increase the indicator's sensitivity. And a higher period, as I'm sure you can imagine, will reduce the sensitivity. This will all hopefully make more sense as we dive into the RSI methods. Now, for those interested in the mathematics behind the indicator, let's just take a quick peek at the calculation. So it essentially provides you a number, as I've already said. The RSI provides you a number between 0 and 100. So how is this value calculated? As I said at the beginning, I will try to simplify this as much as possible, as I assume most of us here are not really interested in the maths, and essentially most will assume that if they see the RSI value on their charting packages, that the number has been calculated correctly. I do very much doubt any of us sit here calculating the RSI if we use it. So anyway, here's the rather grim looking formula, which is essentially 100 minus 100 divided by 1 plus the RS. So the relative strength index, the RS means the relative strength. And all the relative strength is the average of all up moves over the last 14 periods and the average of all down moves over the last 14 periods. Again, if you've chose the 14 period in your indicator. To get the average, we simply sum the moves and divide by 14. So it's simply, imagine your simple moving average. It's an arithmetic average. So yes, we simply sum the moves and divide by 14. Once this is done, we can divide the average of the up moves by the down moves to give us the RS, or relative strength. We then, as you can see, we add 1 to this, then divide by 100. This value is then taken from 100 to give us the RSI value. So look, as a quick example, let me just get my pen out. So as a quick example, assume the average gain is, say, 0.24, and the average loss is 0.10. Excellent. Dividing these two values here gives us the RS, or relative strength. And what this does is, if we divide these two values, this gives us 2.4, I believe 2.4. We then add this value to 1, as you can see here, this point here, which equals 3.4. And following this, we simply divide this by 100. And to give approximately 29.41. 29.41. And then what we do is we take this from 100. So we minus 100 from this. So 100 minus 29.41 gives us an RSI value of around 70.59. But look, guys, I'm pretty sure most of us are not going to sit here calculating this, but it's always nice to know that the RS is made up of average gains and average losses. This will really get you thinking about how the indicator actually functions. A point I will note, when I tried to calculate this off of a basic calculator, it never really give me the correct, an accurate RSI value. You always have to use really Excel, I found anyway, and it will give more precise figures. So let me just clear this mess, and we'll get moving on. So with that out of the way, we can, if you're going to use the indicator, you'll need to hone in on the various methods used by professional traders. So first up, as you can see here, defining the trend or current movement. So for this, I will use the same slide as a few minutes ago, as you can probably see, to help define demonstrate this. So personally, for the RSI, I know of two ways to help define the trend. The first is a bullish or bearish 50 center line cross. And secondly, we can also look at bullish and bearish failure swings, which we will touch on very shortly. Again, excuse my artistic interpretation here, but here goes. So a rising centerline crossover, which means the RSI value is now above the 50 center line in the direction of the 70 area, the 70 threshold. Now, I shouldn't have had that arrow on there. Excuse me, guys. The 7. So so an RSI centerline cross to the upside is in the direction of the 70 overbought threshold. And what this shows across to the upside shows that that the trend is increasing in strength. Essentially, a bullish signal until the RSI hits or touches the 70 overbought line. This, if you think about it, informs that. So once we cross above the 50, this is telling us that the average gains are now exceeding average losses. Now think back to the formula. So the average gains are now exceeding the average losses in this market. And that is positive momentum. So if we just click back to this arrow, so a falling centerline crossover takes shape when the RSI value elbows below the 50 center line in the direction of the 30 oversold threshold. This, of course, so coming below the 50 center line, of course, informs us that average losses are now exceeding average gains. So it's all about average losses and average gains with this indicator. So that's all there really is to it with in terms of the RSI for bullish and the bullish and bearish centerline cross is the main one really. And yeah, so and obviously the bullish and bearish failure swings will be touched on very, very shortly. So next up, we have what's known as overbought and oversold signals. Again, I've kept the slide format pretty similar as the drawn examples do help show what I'm trying to demonstrate without the distractions of a real-time chart. However, we will get to charts shortly. Quite simply, then, when the RSI climbs above the 70 mark, so when the RSI enters this blue area, excuse me, guys, when the RSI enters the 70, climbs above the 70 area, we are now in oversold. And conversely, movement beneath the 30 threshold draws the indicator into an oversold condition. Look, so Wilder in his book actually refers to overbought and oversold as just tops and bottoms. So he referred to the overbought as a top and the oversold as a bottom. Okay, so however, I've also seen I've seen this movement referred to as overvalued, so overvalued for the overbought and undervalued for the oversold. So look, I simply see overbought and oversold as warning signs, nothing more. I would never in my wildest dream trade a market that's just entered into overbought. Although you do see, if you look back at price action, you will see that price, the indicator just touches here and then you'll see the price dip lower. It does happen, of course, but I just would not do it. I look for more confluence, to be honest. So an RSI value within overbought tells me that longs might not be the best move at the moment, and vice versa for oversold with shorts. So a key point to note is the RSI tends to top and bottom out prior to price action, providing an indication that a reversal could be on the cards, or at least a reaction may be seen. So, and these tops and bottoms that form within the overbought and oversold areas, which are shaded in blue, as you can see here. Think of these areas, zones where buyers and sellers show exhaustion. That's all it really is. They're showing that they will potentially show exhaustion within these areas. So buyers, the upside momentum tends to level off within this area. Likewise, downside momentum tends to level off within the oversold region. But this can be difficult to use in trading, as if the market is in a trending environment. Now, a perfect example of this is the dollar yen. Right now, the dollar yen is on a tear, right? The dollar yen has been rallying, I think, for the past 7 weeks. And if you take a look at the daily timeframes RSI, you'll see that it's an overbought. I believe it's offering a double top formation, but it's still not exited overbought. So I can imagine the amount of traders that have taken shorts in this market based on price, the indicator leveling off, given even a double top Q within the overbought area. So the key point to note is, within a trending environment, the RSI can remain within overbought and oversold for a prolonged period, potentially causing a number of false signals. As many traders will be looking to short the market when the RSI value enters overbought, for example, and if it remains within this area, it could, of course, be problematic. So how do we as traders combat this? Now, some traders look for the RSI to actually form a peak within the overbought, or a trough within the oversold. So as you can see here, roughly drawn by, so we're looking for this, and some traders even look for price to actually exit the overbought and oversold areas before considering it a valid signal. Okay, next in line is something I'm sure we've all heard of, is the RSI divergence. Wilder actually stated in his book that the divergence signal is the most indicative characteristic of the RSI. So divergence is formed when, divergence is really formed when when price movement and the RSI indicator diverge. So they move in opposite directions, which can provide a very healthy cue of a market turning point. Now, divergence is essentially a signal that the current trends on the chart traded, that is, has lost momentum, or is losing momentum, should I say. It is the opposite of a confirmation signal, which is when the indicator and price are moving together. So momentum, or the speed of price change, as I'm sure most of you know, is helpful when assessing trend strength. The RSI actually does a very reasonably good job in telling traders when the trend or decisive movement is slowing. Though the through the centerline cross. So remember, if the centerline cross, if the RSI crosses below the 50 center line, this tells us that average losses are exceeding average gains and upside momentum is certainly weakening. We also have the overbought and oversold signals to look out for, but what we're looking at now is divergence. So this lessening of momentum, of course, can be difficult to decipher on a naked chart, so no indicators, especially for newer traders. However, it is critical to note that less momentum as measured by the RSI does not always translate to a reversal, but it really does signal something is potentially changing. So this could mean the market's action is taking a breather, so consolidating before the next move leg up in an uptrend, for example, or it could simply mean it's a reversal on the cards. Okay, enough of this. Let's shift to the oh, whoops, sorry guys. Let's shift to the diagram on the slide. So divergence, as I said, so it really so it helps solidify our understanding. I thought it would be a good idea to show common divergences in drawn form, as you can see here, first, and then underline the practice on a couple of charts. As you can see, there are four common common divergences newer traders must be aware of. We have a bullish and bearish, hidden, and these are regular divergences. So we have hidden and regular divergences, both bullish and bearish. Although this diagram may seem complicated especially to newer traders, I hope in a few minutes this will not be the case. So regular, as you can see here, regular, let's stick with the strong version, okay? Just this version here. So as you can see, price is, imagine in a downtrend, price is forming lower lows, lower highs, lower lows, and yeah, so we're forming lower lows. One second, I'm just trying to work this out. Yes, sorry. So we are forming lower lows on price, but the RSI oscillator, as you can see, has formed a higher low when the price action has formed a lower low. So what this is telling you is upside momentum is beginning to gain strength. Okay, whilst price is still continuing lower. So what does this mean? This leg here could potentially be a weak leg. Okay, so here we had strong downside momentum, but here the downside momentum is beginning to slow, and that's shown through the RSI. Remember, all the RSI really is a derivative of price action. So it's showing you what's happening on the chart. And as I said, it's good for newer traders to be able to decipher the momentum change. Now look, bearish, this is the oscillator, the RSI oscillator. This is the price, of course. So bearish divergence, again, a strong version. Price is in an uptrend. So imagine we're higher high, higher low, higher high, higher low, higher high. So we all think the trend's going to continue, but on the oscillator, we have the RSI forming a lower high. So if the buyers were strong, let me just get my pen out. Excuse me, guys. If the move to this higher high at this point here was indeed strong, you would see confirmation from the indicator in the same format. But as you can see here, we have a lower high in the indicator, right? So what this tells us is average losses are beginning to exceed, are beginning to take control. So are beginning to exceed average gains. Okay, so this tells us that upside momentum is beginning to slow. Now, as you can see here, you do get different versions of this, moderate and weak. But look, really, all I focus is on this, the strong version. There's not much difference, to be quite fair with you. I mean, you can get the indicator that when it forms just a double bottom, as you can probably see here. That's terrible drawing. Excuse me, guys. So you can. So here's a better one. So here's a weak version. And the reason why this is weak is because, look, we have a double top, very similar to the RSI on the daily time frame. We have a double top formation formed on the RSI oscillator when price has made a higher high. So what this tells us is, average losses are not really exceeding gains too much right now, but it's showing, a weak sign, as we can see here, a weak sign that momentum may struggle to continue. So it's very different from the strong version. Now, the hidden, this is very important. So just let me confirm, these are regular divergences. I'm not going to write the whole word out. Regular, okay, regular. But this is the hidden. So regular are good for looking for reversals, not necessarily trend reversals. Yeah, I mean, you can look at dip buying within trends. You can use the regular bullish and bearish divergence within trends to find the peaks and troughs. But you can also look at hidden divergence. Now, hidden divergence is I've mostly seen form as continuation signals within a trend. So for the hidden bullish, this is the bullish divergence, the hidden bullish divergence. We can see that price makes a higher low. We can see that price makes a higher low, but the indicator makes a lower low. So really, and just really quickly, the bearish divergence is very similar. Price makes a lower high, but the indicator actually makes a higher low. So what it is we've swapped over here. So the price is almost leading the indicator to a point. Right, so just something I will add before I continue is I do like to see the regular bullish and bearish divergences form within the overbought and oversold regions. So if you're looking for a bearish divergence, you would want to see it form within or close to the overbought area. Vice versa, for a bullish divergence, you'd want to see that form in the oversold area. This is not necessary, but it's just something I look for, and to tip the scale in my favor. Look, hidden divergence essentially occurs when the trend holds up despite momentum going against it. As you can see, momentum is against this. The price moved the higher high, the higher low at this point here, but it's despite momentum going against it. So this echoes strength in the price move, right? And offers a continuation, as I said, continuation signal within the prevailing trend. So look, despite the growing bearish momentum implied by the RSI for the hidden bullish divergence, this is the bullish divergence. So despite the momentum, the bearish momentum implied by the RSI for the hidden bullish divergence, the trend, as I've said, I just want to really want to repeat this. The trend structure, the higher low, as you can see here, has held its ground. Hence, the hidden divergence represents a window for joining a potential trend. At a bargain price, potentially at a higher low. So look, it's important to keep in mind that regular divergences are possible signals for trend reversals, while hidden divergences focus more on the, just bear with me, guys. I'm just trying to move my pen out of the way. There we go. Yes, so hidden divergences signal trend continuation, and regular divergences focus more on the trend reversals or reactions, or considerable reactions. Oh, there we go. There's the next one. Okay, onto the euro dollar daily time frame. So I hope you can see this, guys. I hope you can already see this. Okay. So we have the, as I said, euro dollar daily chart showing regular bullish and bearish divergences. So one thing I really want to make clear here is the indicator is calculated through closing prices. So we do not mark the indicator from the candle extremes. We mark it from the closing prices. Okay, as you can see, I've done on the chart here. So as you can see here, we have, what's this, guys? We have a bearish divergence. As you can see, price has formed a higher high, but the indicator has formed a higher low. And where is it formed? It's formed within the overbought area. Same here, guys. Overbought area above 70, and we've got a divergence signal shown here. Now, as you can see at this point, let me just note this up because this is something you may be interested in. We have almost, I think they're called, I think they're just called double divergences, or it's not a complex divergence. As you can see here, we have, look at all that divergence there. We have almost like a double divergence. So this is a really strong signal, as you can see there, and then price ultimately does dip away. Up here, we also have another divergence signal, bearish divergence, again within overbought, and then we have a bullish divergence signal within around or very close to the oversold threshold. And as you can see, lower low, higher low within the indicator, lower low within the price action. So this is giving us a signal. This is giving us a signal that downside momentum is something. Look, you can even see it on the chart. Look at this downside momentum at this point here. Strong downside momentum, as you can see. And that is, if I'm looking at it correctly, that is this part here. And then we have this little bit here representing this part here. So if you, once you get used to price action, you can almost see it occurring, but the indicator does make it easy. I'm so sorry for that mess. It's disgusting, isn't it? So I apologize for my drawings, but I hope you get what I'm trying to say. Any questions, guys? Just please fire away, and I'll try and make it as clear as as clear as I possibly can. Right. So next one. Here's the same chart, of course, and I hope you can see what we got here. Now we have the hidden bullish and bearish divergence. Now we have the hidden bullish divergence at this point here. As I said, guys, this is very, very difficult to find in the overbought and oversold areas. As you can see, it's in almost no man's land between the 30 and 50 area. So look, price action, again, from closing prices, okay? We don't use the extremes. So price forms a higher low at this point here, but the indicator has formed a lower low. So price is showing a lot of strength at this point, okay? So look, this is a signal to buy at this point, according to the indicator. Then we have another one here. As you can see, price has formed a lower high, but the indicator has formed a higher high. Okay, so these are, this is a hidden bullish divergence and a hidden bearish divergence. Right, okay, excellent. Right, so we're just getting on to the RSI bullish failure swings. Just bear with me. Okay. Right, so RSI bullish and bearish failure swings, which according to Wilder in his book are very, very strong indications of a market reversal, which is why I'm so shocked not many traders talk about this. Look, so as I briefly said at the beginning, these formations are, as I said, rarely used. Right, so failure swings are independent of price action, focusing solely on the RSI for signals and ignoring the concept of divergences, but they usually form following a divergence. So what you can do is you can use the failure swings as additional confirmation on top of your divergence signal. So as shown on the slide, and just to be so as shown on the slide, this is a perfect representation of a failure swing bottom, as you can see here, or a failure swing top, or a bullish failure swing or a bearish failure swing. So first up, we have a bullish failure swing, so the bottom. So a bullish failure swing forms when the RSI moves below 30. As you can see, below 30 at this point here, this would be the oversold threshold. So we move below 30, and what it does is the indicator bounces back up above 30, forms a high, which is called your fail point, and then forms a higher low. Okay. Now it's important this higher low does not exceed. Does not re-enter the 30 threshold. Now, some traders do accept this. I don't. I tend to stick to the textbook way of doing things, but especially with things like this. So look, the low was not exceeded, resulting in a failure swing. So a failure swing it failed to swing lower. Okay, so that's all you have to think. So once price, or if price continues higher and breaks this fail point, this is where you have your bullish signal. For exactly the same for the failure swing top or bearish failure swing. It's just the opposite, guys, just the opposite to the bottom. We form a high, we form it above the oversold 70 threshold, and we form a fail point. Then we form a lower high within the indicator that does not exceed this high or enter the 70 threshold. So it's a failure swing, guys. It fails to swing higher. Then we continue lower, and we breach the fail point, which is essentially the low, right? We breach this, and then we can look for sell signals at this point here. So you can think of these formations as the beginnings or the potential beginnings of a trend which form before price action. Okay. Right, so here we have, so this is exactly the same slide as we was working on before, the chart of the euro-dollar daily time frame. The bullish divergence formed here at this point here, as you can see, was then later confirmed by a bullish failure swing. Remember from the slide previous, this is a bullish failure swing. Try and picture this in your head, and then we'll spin around to this one. We have the indicator touching gloves with the 30 threshold, forming a fail point, a high, which could be at this point. Imagine we have none of this movement here. This could be considered a lower high at this point. A lower high, yes. And then we continue, lower, but we do not enter the 30 threshold, right? So we form a higher low at this point. So it's a failure to swing lower. And then we continue higher and we break the fail point, and then we have another confirmation signal to buy. Now, if you remember, guys, if we want further confirmation, we can wait for the RSI to cross above the 50 center line. But look, you can sit around all day waiting for confirmation and things like that. But at the end of the day, so you'll be losing a lot of return waiting for all this confirmation. I do like the bullish and bearish failure swings as confirmation for divergences, but not as big as this. This is too big for me. So I'd like a nice small one here, and then a small fail point at this point around here, so it gets me in at a decent risk reward space. And we also had a, I think we had a, oh yes, we had, I think it was a bearish failure swing here. I did check this, I believe, and it didn't hit the 70 threshold. So look, what we have is another one here. Let me just get the pen. Okay, so we have the high of 70 here. We drop down, we form a fail point here. We come back up, we do not connect with the 70 threshold. And then we cross below the fail point to give us a bearish signal following this divergence. Okay, pretty simple stuff, guys, but something that I believe, really can add weight to your trades. It really, really can add weight. Okay, now we've seen some of the ways in which traders interpret the RSI. I thought it would be good to round off with, how we can really use the indicator in trading. I will start off saying, and this is just my opinion, using the RSI in isolation is not really something I would recommend. What I mean by this is, for example, entering short after the indicator registers overbought, or even exits overbought. I know some traders do look for that, but it's just never really worked for me. I can only just give my basic my opinion, really. The same goes for the other methods shown here this evening, including divergences. I always look for more confirmation. So how do we use this RSI? It's a great tool for confirming other technical tools. So we can use it to, of course, technical tools will vary depending on the different traders, I guess. So for me, I'm a huge fan of price action, and I've been using it for years. So we can use it to confirm our price action concepts. So to briefly show what I mean, we can see again the euro-dollar daily time frame. Now remember this example: bullish divergence, RSI failure swing, bullish failure swing. And look at this, we had a nice, very nice trend line support extended to the upside, which was confirmed with regular bullish divergence, and then later an RSI failure swing. You see, what we've done here is built, you can call it idea generation, I guess. We have a trend line support, we have the RSI, divergence along with the RSI failure swing. We also have support at this point here, I think around this area. Look, it's not a straight line, of course. Oh, I do have a straight line on this. Just bear with me. I can draw a straight line. So you also have a Quasimodo support at this point here. So the Quasimodo support is the left shoulder at that point there. And I believe did we have something here? There was something, look at that. We have, this is not a trend line, by the way, guys. Let me just, that should be joined to there. This is not a trend line. This is more of a descending support. So that should be joined to that point. So you can see we've built an idea, right? And we've used the RSI as a form of confirmation. Right, let's clear that. Okay, just quickly before we wrap things up, I do want to highlight that the RSI can also display support. The trend line, example here. So as you can see, just another example, but this is with the RSI hidden bearish divergence. As you can see, we have the trend line, as you can see with the arrows here, trend line support turned resistance, confirmed by RSI hidden bearish divergence. Okay, and for any harmonic traders present, we also had an AB equals CD formation into this area. For any harmonic traders, there's a lot of confluence at this area here, telling you to consider some shorts. So yes, so this is it's a fantastic confirmation tool. It's one of the best indicators for me personally, and yeah, so I would thoroughly recommend it as a way of confirming your trades. Okay, right. So just quickly before I hand things over to any questions, I do want to highlight the RSI can also let me just show you, can also be used to display actual support and resistances. So you can actually find patterns. Remember I said on the dollar yen we have the a double top forming on the RSI daily time frame, and the RSI indicator applied to the daily time frame. But you can also use trend line supports. Let me just draw one on for you so we know what I'm talking about. We can use the RSI trend line support. And then once price breaks that trend line support, we have a potential weakening of downside momentum. We also have support and resistance we can use. So yeah, it's just you can look for patterns. I'm just trying to find a pattern. Yeah, I can't really find much in the way of obvious patterns right now. But yeah, so you can use support and resistance, as I said, and things like that to really tip, as I said, tip the weights, tip the scale in your favor. Right. So with that in mind, let me just see if there's any questions. Hi, Steve. You buy at the breakout of the divergence. Whoa. Can you was this on the previous charts you're talking about, or is this just a question? Was this to do with this chart at all, or buy on the breakout of the divergence? There is no breakout on the divergence. You'd have to be a little bit clearer because I'm not sure. You mean, would you buy following the breakout, following the divergence? Yeah, I'm not really entirely sure. Oh, with the failure swing. Perfect. Right, let me just see. Here we go. So you would look for this is the daily time frame. So you would wait for the day to close and you would buy the breakout. I mean, you could try and be very sneaky and look for the retest on the indicator, but yeah, you would buy the breakout of the failure swing. That's exactly it. So look at the slide. Go back. There we go. So we buy here. We buy the breakout. We sell the breakout at this point here. It's just it's a nice way to confirm your divergence. But as I said, try to avoid these big ones here. Even though it worked, try to avoid them. Try to look for these smaller ones. You know, these kind of ones. So we get this one here. We touch the 70. We come up, form a little fail point there. We form a higher low. And then we break out higher. So look how close it is to our signal here. That's what I'm looking for. This is a huge one. I'm not really interested in that. I'm interested in the small ones that give me added confirmation and give me a chance still to make some decent returns. I hope that answers your question, Steve. Oh, Yazid. Okay. Can we consider the RSI as a volume indicator instead of showing the... Oh, I'm not really sure, to be honest. I'm not sure if the other guys can see this, but the question is, can we consider the RSI as a volume indicator? Instead of showing velocity of price, we can, for example, use it to assess the trading volume of a... No, because if you're talking about the RSI, that has nothing to do with the volume. It's all about momentum. If you want volume indicators, you would have to use the volume indicators. I've never really used volume indicators, to be honest. I've used the volume as a signal. Very similar to this though. It's divergence and things like that. Confirmation signals with volume. But no, I've never used. You can't use the RSI as a volume indicator unless I'm misunderstanding the question. So yeah. Okay. So are there any other questions, guys? While I'm waiting, I'll just round things off. So look, if you do want to get in contact with the research team here at FP, feel free to send us an email at marketanalist@fpmarkets.com or alternatively support team at let me just get the slide up. Just bear with me. There we go. There we go. So support team at fpmarkets.com. Send an email to either one, and we'll get back to you as soon as possible. If there are any specific webinars you want us to cover, go ahead and let us know, and we'll see what the team can do. Also, be sure to register for the next webinar later on this month on the 24th of May, and that comes in as you can see there. Position trading, the power of higher time frame trading, Tuesday the 24th of May. It's at the same time, guys, so be sure to register for that. Position trading, especially the power of higher time frames. I use this every single day in my trading, so do be sure to register for that. Also consider registering for our Telegram channel. So please subscribe to our Telegram channel, as you can see in the chat box there. To get instant updates. We're pretty active on there with updates of the markets and some sell-ups and things like that. And any more questions, guys, before I wrap things up? I think I've got most of them. Let me just check. Okay, so it looks like I've covered everything. Look, I really hope you took something from this presentation. Again, there will be a recording of the presentation available. Feel free to watch that and send me any questions, and I'll be happy to answer. Have a great evening or afternoon wherever you are in the world, and thanks again so much for taking the time out of your schedules to attend the presentation. Have a great night or afternoon, and I'll see you all again very, very soon. Thank you very much.